In this video, I'm going to talk about the 1 hour pattern that actually nobody talks about. And once you understand it, you're going to see the markets completely differently. So make sure to stick till the end to soak up all the knowledge I'm about to spill. But just before I show you what it is, I just want to show you some kind of proof to see I made $90,000 in the span of just few months. You can see all the results from the months. And another thing is you can see my second channel where I literally live trade. I show all of my losers, all of my winners. So if you are interested in seeing that, just make sure to check it out after the video. So with nothing else to add, let's just get straight into it. So before we actually get into it, I just want you to look at all of these trades, and you are probably not gonna figure out anything or why did I take them. But by the end of the video, when I'm done explaining everything, you're gonna understand why this one was invalid and why it instantly lost and why the other ones won. And you're gonna perfectly know with all of the rules whether to take them or not to take them, and basically whether they were A or B setups. So I'm gonna teach you all of that right now. So the first thing that we are gonna learn about are two confluences. Now I'm pretty sure you're gonna say I know them, I'm just gonna skip this part, but wait, because we are going to look at them completely differently. So the first thing is going to be very simple. It's called fair value gap or imbalance. So imbalance in the market or a fair value gap is going to be very simple. It's going to be consistent of 3 candles. So you can see first candle right here, second right here, and third right here. So we always need to see a minimum of 3 candles. And the second thing we want to look when we are searching for a fair value gap, we want to see a imbalance or some kind of push created in the middle. So you can see that the middle candle right here is the biggest of these 3. It doesn't need to be the biggest, but the point is we want to see this hole in the market. I like to call it hole because it's quite literally hole. You can see that from this wick to this wick there is nothing, there is just a body in the middle, and that is called fair value gap or a imbalance. So if the wick sizes are different, let's say for example this one was like this and this wick was like this, then the fair value gap wouldn't be like this, but it would be from the top wick of the first candle to the bottom wick of the third candle. So it's fairly simple. All you look is for this hole in the market. And now the little bit more complicated thing, but I'm going to make it so simple, and that is liquidity. So I'm going to go all the way right here for the liquidity. We are going to move it like this. So liquidity, what is liquidity? So I'm going to explain it as simple as possible. So this is some kind of market's perfect movement. So everybody thinks that when market is moving, it is going to create higher highs like this and then higher lows like this down here, and it's just going to continue that forever until we make some kind of market structure shift and start making lower lows and lower highs like this. But that's actually not the case. This is what everybody thinks in the beginning that it's going to be like in the market, but when they try it out, it doesn't work at all. And I'm going to explain you right now why is that. So the first thing that we need to understand, market is always going to stop somebody out. So it's always going to manipulate people out. It's going to take people's stop losses, and that is going to result in something called liquidity. So the most simple term to call liquidity is somebody's stop loss, and by somebody's I mean all of the day traders, all of the unprofitable day traders, which is about, I would say, 95% of people in the market. So why is that actually important to us? Why is liquidity or somebody else's stop loss important to us? So let me explain you this. So this is some kind of a market movement. I'm gonna move these that we just drawn, and this is some kind of market movement. We push to the upside, then we push to the downside, and we push to the upside, then we push to the downside. So it's always quite the same thing. But the thing is that people are going to see this. People are going to enter buy positions, of course stop loss at something logical, so a most recent low, and target something to the upside. Then it's going to happen again once we have the pullback. Let's say we retest some kind of their zone that they want to enter from. They enter another position to the upside. What do they target? They target some kind of level to the upside. And what do? They put their stop losses on the low. So what do we do right now? We don't want to enter the market. Why? Because there was not any manipulations in the market. So market is always going to do these manipulations where we are making some kind of structure, and then the market is just going to collect all of the stop losses like this and basically just stop everybody out, manipulate everybody out from the market, and then just make what it needs to make. So make structure to the upside, and then again later is going to do the same thing, collect some kind of stop losses, and then continue doing the same to the upside. So you've probably seen this a lot of the times in the market, where the market just completely swept everybody out. So all the lows like this, let's say like this, and then after that it actually continued going in the direction. But what happened after they kind of collected all of the stop losses? So they collected stop losses right here, then these stop losses, they collected them right here, and then what happened? All of the people think that market is right now doing some kind of market structure shift, because we had like break of structure right here and a break of structure right here. And what they are going to do is they are going to enter short positions. So it's going to be very easy to manipulate people out, because the banks, the big institutions, they need to extract money from the markets, so they need to manipulate people out. So when they enter positions now to the downside like this, and they wait with some kind of orders like this, what is going to happen? Market is going to have another basically opportunity to just manipulate everybody out, because when they get tapped into the market like this, maybe market is going to give some kind of reaction, and then it's just going to take all of them out and continue with the true direction that market actually wanted to do at the beginning, as we saw right here. So if we want to simplify liquidity and what liquidity is, we can say that liquidity is somewhere, someplace where everybody is going to put their stop losses, and that place is always going to be some kind of low or some kind of high in the market. So this is a low, this is a low, that is a liquidity, and that is a liquidity. Also, this up here is a liquidity point. Why? Because market reversed, so a lot of people are going to assume that market is kind of going to reverse and enter the market to the downside with their stop losses above and just targeted something. So this all is going to be liquidity, and this right here is a taken liquidity. So we can see that market already swept this. So liquidity is going to be very important for us, because we always want to see some kind of liquidity get swept before we enter the market. So now that we know what a fair value gap is and that we know what a liquidity is, let's see how are we going to pair them together to get into a setup. So as I told you in the beginning, we have two kinds of setups. We have A setups, which are the best, the biggest win rate. I like to call the win rate about 80 to 90% win rate, as you saw in the beginning in my tracker that I showed you at the beginning. So we have A setups from 80 to 90% win rate, and then we have B setups. They are about 70 to 80% win rate, so still very profitable, but we gotta make the difference between these two, so we know whether we want to take the biggest possibility setups that are going to show less times in the market, or the less probability setups that are still very profitable, but there is going to be way more of these setups in the market. So the easiest way for me to show you this and for you to understand how are we going to make the difference between these two is A setups are going to have two arrows or two confluences. So one has to be a fair value gap and another one has to be liquidity. So A setups are going to have both fair value gap and liquidity present, but B setups on the other hand, they have one arrow, as you can see. So they either are going to have only fair value gap, so B setup has only fair value gap present, or only liquidity. So B setups are going to have liquidity or fair value gap, not both, because if they did have both, then they would be A setups. But then A setups on the other hand are going to have both fair value gap and liquidity. And right now I'm going to show you actually how we can see and spot and take the setup in the live market. So let me show you. Okay, so what I'm going to do is I'm going to reverse the market completely right here. So we have all the setups that we got to go over, but let's go over each one of them. So what did we say at the beginning? So we said we need fair value gap and liquidity for A setups, or we need liquidity or fair value gap for a B setup. So let's see what does this first trade have. So the first thing that we are looking for is we see that market has few fair value gaps right here on the left, and we can see that wicks are respecting the fair value gap. So we don't want market to actually do this where we just completely close below the fair value gap and kind of disrespect it. We want to see market respect it with the wicks. So we see that we disrespected some, but we are still respecting these fair value gaps. So we only need one fair value gap to actually make the trade valid. So fair value gap, we do have it. Now the liquidity, also we can see the same thing. We are making structure to the upside, and what happened, this liquidity right here got swept. So market manipulated this liquidity out like this. And what do we expect? We expect market to continue to the upside. So let's see what will actually happen. So market has liquidity, market has fair value gap. So what setup is this? This is a setup right here. So let's see how do we get the entry. So the entry is going to be really smart, and it's going to be the main part, but it's still going to be one of the things we have already learned. So it's going to be a fair value gap. So once we actually get the confluence, so once we actually get the fair value gap or liquidity or both of them for a setup, we want to see fair value gap that was created while we were going towards it. So you can see right here, this is the fair value gap that was created while we were going to the downside to actually sweep the liquidity and to retest the fair value gap. So we mark this fair value gap out like this, we can extend it, and what are we looking for? We are looking for the market to disrespect it, because that's kind of reverse psychology, but when you look at it, it's actually so smart. Because why would market disrespect this fair value gap if the market wants to go to the downside? Because if it wants to go to the downside, it would just come here, respect it, and bounce off to the downside. So all we need to wait is for the disrespect of this fair value gap. So we still haven't closed, so wicks are not important. What we want to see is a close of this fair value gap. So let's see if we do have it. So market is just wicking around, and let's see. And right here, so this candle right here still did not close above the fair value gap, but then the next candle just completely closed the fair value gap. What do we do with the stop loss? We put it always underneath the fair value gap that we already inversed. I'm also going to show you some kind of different stop loss placement for different scenarios, and let's see what does this trade actually do. And it just hits straight the TP. So the first A setup right here that we had is a win. So let's go on the second trade. So right now, the second trade, what do we have? We have liquidity right here. So we swept this liquidity right here. And if we look to the left right here, we don't have anything. We don't have no fair value gaps. We don't have anything. So this setup right here is probably going to be a B setup. So B setup right here is probably the next setup. So let's wait and see how do we get the entry for this setup. So we are still waiting right here. Okay, so the market is going to the upside again, and let's see what the market does. So market swept the liquidity one more time. So every single high, every single low in the market is liquidity. What do we see? We see a fair value gap that was created while going to the new liquidity high up here. And what happened? Market inversed or closed below the fair value gap that we were looking at. And what do? We enter the trade. So we enter the trade right here. And what do? We just wait for the trade to play out, and let's see what happens. So trade goes almost to the TP, and is it going to hit? And there it is. So it hit 1-to-1. And also one thing that I like to do is I like to either target a liquidity point or 1-to-1, but 1-to-1 is just the most mechanical and most easiest to execute, so I like to go with it. And now for this trade that I told you guys it wasn't valid, but later we are going to find out why. Right now let's see why it wasn't valid. So if I fast forward the market, you can see that the market did not even sweep the liquidity. It does not have any deliveries whatsoever, so nothing right here. And if we fast forward the market, you can see that market has this fair value gap right here. And if we wait for the inversion or the close above, you can see the trade is just going to straight lose. So we are going to move this trade out of the way because it was not valid at all, because it was missing both liquidity and fair value gap. And now on to the next trade. Let's see what does it have to offer us. So we are going literally nowhere, we are just staying in the same place, and you can see that the market has swept this liquidity point. So again, another B setup potential right here. What do? We have fair value gap right here. You can see quite a small fair value gap. And what do we have to wait for? We have to wait for the inversion of that fair value gap. So what happens? Market inverses stop loss. Now why don't I place stop loss above the fair value gap? So what I do is, if the single candle has not done this, I like to place it below the fair value gap. But when we have a single candle like this one or like this one, I like to place it at the top of the candle. So that's something I like to do. You can do it this way, but then stop losses sometimes are going to be way too tight. So this is the best way to do it. So let's see what happens. And market just shoots straight to the TP, and you can see that potentially if you wanted, you could target a lot more than 1-to-1 risk reward, but the other trades played out to 1-to-1 perfectly. So let's see what happens with the next trade. So if you fast forward the market, you can see that the market is slowing, coming towards it. Let's just see what kind of confluences do we have right here in the market. So it's quite messy on the chart, but I'm not gonna delete anything. So you can see a lot of liquidity has been swept. So all of these lows right here are liquidity. So every single low in the market is liquidity. So we have plenty of liquidity. And if you look to the left, we have this fair value gap right here. If we extend it, you can see that liquidities, fair value gap. So this right here is just another A setup. So let's see what is it going to do. So for right now, the only entry would be this one right here. So let's see if we get anything else in the market. So if we just wait, we can see that we created a new fair value gap. So a perfectly valid fair value gap to use, because we already have all of the confluences. There is the entry, and now let's see what the market is going to do. So came close to the TP, and let's see, came close to the stop loss actually, and then just shot back to the sky. So you can see if we enter the trade on the closure right here, stop loss right below the candle as I told you, so not below the fair value gap like this, because it's just not that high of a win rate if you do it this way. You can see that we just came close to the stop loss, but we did not actually hit it, and then just shot back to the sky. And the same thing again, you can see that we could have targeted quite a lot on this trade. If we wanted, we could target 4 or 5 risk reward, but that is just up to you. Of course, win rate is going to go down, but your risk reward is going to go quite up. So make sure to just try it out, backtest it, and then figure out if you want to target 1-to-1 or some kind of liquidity points like this. You can see if you targeted this liquidity point right here, that would be 4.5 risk to reward. And I always like to say, if you have a, let's say, $100,000 account, which is just really simple to pass and to have, basically this trade will have resulted to you making $4,500 if you targeted 4.5 risk to rewards, and that's just 1% risk. So it's nothing crazy, but it can just make you crazy results. So let's see this trade right here, which is going to be the last one that I'm going to show you. So let's see, it has actually something special, so I'm going to show you that. So the first thing, we have liquidity right here. So we swept liquidity. So for right now, this setup is B setup. But then the second interesting thing happened, which is also very valid, is we retested a fair value gap after the sweep. So we made this fair value gap, you can see we swept, we started going to the downside, and then we came back into this fair value gap, and then we just retested it. We did not disrespect it, we retested it. So that makes this setup a setup. So we have liquidity and we have the fair value gap. So the next thing we want to see is the last fair value gap to actually get inverse. So this is the fair value gap. So let's see if the market is going to inverse this fair value gap. So still no closure under, and you can see market rejecting to the upside since we didn't close, and there is the closure. So if we enter this position, you can see that market just spiked to the downside. So this is the last trade, the 8th trade. But before you actually leave the video, I actually want to give you something for completely free, and it's gonna be so valuable because it's the whole playbook of this strategy. It's a 10-page PDF where you basically have all of these setups laid out completely perfectly. So if you want to have that playbook, go down there to the description and just claim it for completely free. Also, if you like the video, make sure to like and to subscribe to see more of videos like this. And if you have any questions whatsoever, just comment them down below. And also I have free community if you want to join. Just press the link down below and you're going to be able to access a great community of the traders who are actually trying to make it in trading. And basically that's it. If you subscribed and like this video, you are not gonna miss any of my future videos. So with all of that being said, I'm gonna see you in the next one. Peace.